Hi, I'm Dave Brickell, Director of Sales at Paradigm. Welcome to The Big Picture.
Vol is reverting, so the obvious trade is always the expensive one to
this
carry.
whole peak inflation, peak rates narrative, peak Fed, which we've been talking about.
It's an expensive place to find out. Crypto vol, a potentially fatal place to find out.
The crypto option markets are definitely showing some signs of life.
Hi guys, welcome to The Big Picture. My name's Joe Cruey. I'm at Paradigm in the weeds around everything crypto vol markets. Joined here again by my colleague David Brickell and Sohan Sen, as well as Noelle Acheson, the author of the Crypto is Macro Now newsletter, which examines the intersection between crypto and macro landscapes. So Noelle was formerly head of research at CoinDesk and Genesis Trading. Before we begin, if you could just subscribe, hit that like button. It really helps us as we continue to promote this channel and provide content to you guys on a weekly basis. So just to start, Noelle, if you can quickly just introduce yourself to our viewers, a brief overview of your background, how you got to crypto, and what you're doing with your newsletter now.
Thanks so much, Joe, and I'm really glad to be here with you today, especially today. I mean, there's so much going on. Brief background, condensed. Started out in TradFi, did corporate finance, equity research, ended up in fund management. And I left that when my son was born because I was doing futures and options back in the days. I actually understood them. I was not compatible with breathing back in those days. So I left that to set up an e-commerce company, one of the first in Spain at the time, which is where I live and was living at the time. One of the first in Spain, ran that wasn't the first, it was one of the first. This is back in the day, slight parenthesis here, when people we couldn't find a logistics company that would be willing to work with us because nobody's ever going to buy anything on the internet. And this was as recently as the year 2000. And I only throw in that parenthesis because it's so relevant to what we're all doing in this industry today. Everyone who says this is a fad, it's just for speculation of views, I will never forget back in the year 2000, no one believed in e-commerce. Anyways, carrying on, I ran that for 13 years, sold it, then was figuring out what to do for the next career. I'm interested in finance technology, was doing some reading to catch up on what had been happening in the world in my absence when I wasn't paying attention. Kept hearing about this thing called Bitcoin, watched a video on Khan Academy. You remember Khan Academy back when it was a thing? This was
I love Khan Academy.
Such an amazing concept.
I basically used it as a cripple all throughout high school, like when I couldn't understand physics concepts and things like that. It's one of the best places.
What did people do before this kind of learning aids? I'm telling you. Anyway,
now you have GPT, right? Now you have Khan Academy on steroids, right?
So why even bother to learn, really? I mean, right? Anyways, when I realized that what I was looking at was permissionless payments, I got goosebumps because I grew up in Zambia, in the middle of Africa, and just thinking what it could do in that part of the world, being able to transfer value electronically without having to have a bank account or ask permission. I haven't looked back since. Obviously, it didn't end up being used for what I expected it to be used for, but the more I dug into it, the more I realized how hard it was going to be to get that use case up and running, and also the more interesting it became. You know how when things are really hard and the obstacles are really important, then you're actually probably onto something quite useful there. So I kept digging, eventually wrote to the managing director of CoinDesk and gave him a list of reasons why he should hire me, even though everyone was in New York except for me at the time. And much to my surprise, he actually did. I set up the newsletters for CoinDesk back in 2016, I think this was. I worked at CoinDesk for 5 years, ending up as managing director of research there. And then I went to Genesis Trading a couple of years ago, 2020, I don't remember. 2020 it was. Yeah, 2021, because I care very much about markets. I mean, I'm here for markets. I'm a total markets nerd. Nobody invites me to parties anymore because I am so excited about the plumbing of markets. And because markets for me, especially given where I grew up, markets are a tool for freedom, and they're not being used as that today. They should be, but they're not. And I see crypto as a potential tool to get markets more extended, more open, easy to set up, and enable the transactions that allow for freedom of expression, freedom of savings, freedom of opportunity, etc. Anyways, I learned a lot about how markets work at Genesis, and sad what happened to Genesis, but I know that the trading operation is still doing really, really well. And I left there end of August, beginning of September last year to focus on crypto as macro now. It's what I've always wanted to do, focus on the big picture stuff. And again, especially now, it's one of these things, Joe, that if you don't do it now, then when? When so much is changing out there. And this tool that we have that we haven't had before during previous crises is actually growing in unexpected ways anyhow. That was a long answer, wasn't it?
No, it was a long answer, but it was a good one. And David, that's David's like one of his massive value adds at Paradigm is examining crypto from this macro sort of framework, because it is just a macro sensitive asset. I'm curious about. I kind of know what David's framework is now from like reading his newsletter. I'm curious, like, what is the framework you're using to examine crypto from like a macro lens? And I guess kind of what's your current view? Obviously GDP numbers today.
Yeah, I'll split that into two sections, and I'll try not to make it such a long answer again. One is the macro influence on crypto, which I know Dave is an expert on, and he and I chat about this sometimes off channel as well. And it's the new types of investors that have been coming into the market for the past couple of years that bring their lens with them. When I started working in crypto, nobody cared what institutions were thinking. When I was assigned to cover the institutional market at CoinDesk, there was a lot of pushback from some of my colleagues. I was excited because I come from that world. I speak the language. They're my friends. I know them. There's a lot of pushback from some of my colleagues at CoinDesk. We don't need the institutions. The institutions don't have a place in this market. And my point of view was we do need them for the following reason. Yes, this is a technology that was created to circumvent the need for institutional intermediaries. Sure. But they bring funding, they bring liquidity, which allows for the development of sophisticated markets, which, as a markets lover, is always a good thing. And they bring legitimacy and protection. And even more importantly, if we expect crypto to end up being a retail-first market again, it was born retail-first, it might end up retail-first again, who knows? Retail will largely invest through institutions, through their Schwabs or their TD Ameritrade accounts. So institutions do matter very much for crypto. But another lens that I'm focusing a lot on these days, and one that I'm even more excited about, is how is crypto going to influence macro? We're starting to see that already. We talked about the potential influence on how markets work, on the plumbing. That's the low-hanging fruit. That's the easy one. We know the interest in tokenization of assets is going through the roof. We're seeing big banks start to offer crypto to their clients. So we know that that is already happening, but it's bigger than that even. It's markets around the world that don't exist right now. It's energy policy. It's freedom to transact in fairly authoritarian societies that is going to change economies on a local basis. It's the field is opening up. It's absolutely fascinating.
Yeah, I mean, it's, for me, Noelle, and obviously we had lots of discussions, it's great having like a kindred macro spirit to kind of bounce some ideas off. And I remember when I sort of first came into crypto and was, again, sort of talking very much about the, the sort of macro side and the drivers of that, all the kind of crypto bros just thought I was talking rubbish. But now it's amazing how it's become, a focus for everyone within the space. I think obviously, that there's a lot of focus on like the halving cycles and things like that. But I think now there's an appreciation that, the macro cycle is a massive driver and influence of price, and you can't think about Bitcoin and crypto and where it's going without considering where we are in the macro cycle.
But we've seen what the liquidity cycle does for the prices already. I mean, and that is just scratching the surface, and that is before the big institutional money is even here yet.
What's so obviously we had the GDP print earlier, which was weak. Although sadly the core PCE still remaining firm. What's your thoughts around that first of all, and also how's that kind of feeding into your sort of big picture view on sort of macro and Fed, where that's going, and then obviously how that relates to crypto and your outlook for crypto?
That's a big question, and I did say I would try to not give such long answers, and you're not making that easy. All right, so breaking that down, GDP figures out today. We are so in stagflation. I mean, if it wasn't obvious, it is really painfully obvious now. And stagflation is just the worst place to be. It is what the bond market most fears. It's what investors most fear. And why is stagflation so much worse than recession? It's hard to get out of. Stagflation is when, as I'm sure your viewers already know, it's when you have tepid or negative growth even, and high inflation. That is what we have now. And normally recessions will bring down inflation fast, which is why a recession is better than stagflation. With the stagflation, there's really no reason for it to come down. It's going to stay high and the growth is going to stay low, and that is just not good for anyone. So that's what we are seeing now. I'm going to skip to what this means for crypto, and then we'll come back to the Fed, because that's actually a separate conversation, I believe. What this means for crypto, it's good for Bitcoin, because what do you do in stagflations? You buy commodities. Bitcoin is many things, one of which is a commodity. So this is probably going to add yet another narrative to the already rather textured mix of Bitcoin narratives. And we can come back to why the number of narratives behind Bitcoin is so key. But onto what the Fed is going to do. It's in a rock and a hard place. There's really not much that it can do. I am in the camp that the Fed can't cut rates this year. It just can't. So I think the bond market is getting it wrong. I think the stock market is getting it wrong too, but for different reasons. I think the Fed is actually, I think we should listen to them. When they say they are not cutting rates this year, I believe we should listen to them. Why do I think they can't cut rates this year? Because inflation's just not coming down anytime soon. It's there's no reason for it to. Consumption is still pretty high. Unemployment has not moved. Unemployment has not moved after one of the steepest hiking campaigns since the 1980s. Unemployment hasn't moved. I mean, talk about lags, right? Anyways, also consumption really hasn't come down that much either, in spite of eye-watering rate hikes. So what will it take? Well, what it will take is for the economy to eventually grind itself to a fairly miserable place. It's going to take time. The Fed can't cut also for economic reasons because of the signal that would send. The signal that would send is, we won, we beat inflation, and everyone would come out and start spending again. And that is just not going to help keep inflation down, especially given the trends, the momentum of consumption going on, especially what's happening in other jurisdictions such as China. I mean, they are eager to spend, and they are going to keep inflation high for pretty much everyone. And in terms of the Fed cutting for banking crisis reasons, I don't see that happening either. It doesn't need to. We've seen that it doesn't need to. There are many other tools it can use to ease the collateral crunch. There are other things it can do. It doesn't need to cut to save the banks. And there's no guarantee that we are in for a large banking crisis. I don't think we are. I think the crisis is going to come from other areas. I think they're in trouble for sure. I would want to be a banker today, but I do think the crisis is going to come from other areas. And I'll pause there because otherwise I could keep going down this path.
Yeah, I mean, the banking,
yeah, that's quite interesting, because it definitely seems like you're still bullish Bitcoin and crypto in general, while David is also very bullish on crypto. But David thinks that we're actually going to cut rates. So I kind of want to dig into that a little bit. I mean, David, you're kind of in the camp that's much more dovish, right?
Well, I am. I mean, whether we get rate cuts this year, I mean, it looks a bit punchy to be expecting that. Certainly, the number that the market's pricing, I think is still something, but best part of 100 bips priced in for the end of the year, which looks unlikely. I mean, I'm a little bit more sanguine on inflation, actually, in terms of, I still think, if monetary policy acts with a 12-month lag, which it typically does, we're still yet to really see, the feed through from that aggressive hike cycle. So I still kind of think inflation could fall pretty quickly. You mentioned employment as well. Like, that's always obviously the last of the shoe to drop. So my expectation is over the coming sort of quarter or so, we'll see both growth slowing very sharply. We'll see unemployment pick up, and we've started to see that. We saw those job openings sort of drop quite sharply. Jobless claims is kind of sort of ticked higher. We had some pretty big revisions. So I kind of think the unfolding will actually maybe start to open and allow some cuts. But I kind of think it doesn't matter. Like there's so much obsession around when they cut. So someone was trying to call me out on Twitter for like the pivot talk. Oh, where's your pivot? And I'm like, the Fed have already pivoted. Again, how do you define pivot? But for me, you've gone from 75 bit hikes to now 25 bips and then a pause. I don't know what you define as pivot, but that's quite a rates of change matter, and that's quite a sort of change, at least in the rate of change, if not the actual kind of direction. So I kind of think that the pivots happen, which Noelle, if you sort of follow some of my stuff, was kind of underpinning my bullish view on crypto into this year. I also, whether we get rate cuts in the front end, I think what's important for Bitcoin and crypto generally is, I think of it as a long duration trade. And certainly I think that kind of, the lows were in for duration, probably back in end of October, November. So you see 10-year yields sort of peaked around, I think, end of October, and keep coming lower. And the more that you get this kind of sticky inflation, and the more that the Fed have to just stay in there and stay with it, you might not see the movement at the front end, but you're going to just see a deeper inversion. And I'm sort of super bullish duration. I think 10-year yields will move quite quickly below 3%. And if I'm bullish duration, then I'm bullish tech, and then I'm super bullish on crypto, which is the longest duration asset. So yeah, it's more nuanced than thinking we're going to get rate cuts. I think across the curve, and we have to think about curves in terms of as it relates to crypto. I think we're going to continue to see certainly the long end rates come lower as we price recession and what have you, and that will be a nice positive tailwind for crypto sort of throughout the rest of the year.
Yeah, Dave and I agree very much on where Bitcoin is heading. We slightly disagree on the drivers. I don't disagree that pivot, how do you define it? 90-degree turn is a quarter of a pivot. 180 is just simply continuing, and it's very, very likely that after a pause they'll continue raising. So it's the beginning of a pivot, effectively.
No, how do you think about? Because within my macro framework, two of the big themes, and how I think about crypto, obviously rates, and then liquidity is the other big theme. And I just want to get your thoughts around that. Obviously, we've seen, I think since the fall of last year, about $1 trillion worth of liquidity added. You've had PBOC have been pumping, Bank of Japan, which has offset what the Fed and ECB have done. And then obviously the Fed have had to come in with this sort of mini banking crisis and sort of flood liquidity again. How are you thinking about liquidity? Obviously, certainly in given what's going on in banking. And another thing with that, if that is important, which we believe it is, how are you thinking about it in the context of if we get this debt ceiling lift and then the Treasury are able to come and issue a shit ton of debt and then suck that liquidity out of the market? Is that a potential challenge for Bitcoin in the coming months?
Absolutely. I was laughing because that's exactly what I was trying to figure out this morning. Drawing my sketches on the liquidity goes this way and this goes this way. It would, the debt ceiling, let's assume it is going to be lifted, and that is going to mean a flood of issuance, which is going to withdraw a lot of liquidity from the market. What we don't know is what the conditions of that lifting of the debt ceiling will be. If it's going to reduce spending, then that's going to obviously withdraw even more liquidity because there'll be less money coming back into the market through government spending, and that'll be a double whammy, definitely not good for liquidity. But liquidity is one of the most nuanced subjects in the entire market. There are so many drivers. The U.S. liquidity outlook does not look great, but crypto's leaving the U.S. anyways, so who cares, right? You've got liquidity in Asia. That is definitely easing. That is going to help. You have the oil price coming down. I mean, just this morning, it's now below where it was pre-OPEC production cuts. So oil is probably going to continue heading down. Sure, they can do more production cuts. Actually, they probably can't. It's really not that easy to do production cuts. So oil's probably going to continue to head down. That is a form of liquidity coming into the market because there's more money in your pocket that you're not spending on energy, whether you're a retailer or whether you're a business or whatever. Dollar is probably going to be coming down as well as we get into the slowdown, and that does give holders of US debt some breathing room. It's good for liquidity. So the overall liquidity on the global level is actually not so bad. I think the US is definitely going to problem. The debt ceiling is going to be an issue, perhaps a short-term hit, but I don't think it's going to matter that much as you hinted at. Bitcoin has so many drivers. Liquidity is definitely one of them. And sure, we could see some short-term wobbles as we've seen over the past few days, but there's support for other reasons. For those who believe liquidity will come, anyway, we're past the tightening peak. For those that believe liquidity is irrelevant, it's all about insurance. For those that don't care, they're just looking for a long-term store of value. There's so many different things going on at the moment. One thing that you mentioned, Dave, which I thought was interesting, was employment being the last shoe to drop. I agree with you, and agree that we're starting to see some signs. It'll be interesting to see what the next set of data is going to reveal. But one thing we know for sure is that when unemployment starts to rise, it does so really fast, really, really fast. You look through every single recession and the unemployment rate is, almost vertical, not quite, but it goes up. And no matter what the Fed does, if it dropped rates, which we talked about, I don't think it will, but even if it did, it wouldn't matter. Unemployment moves with momentum. And as the Fed has reminded us many times, with long and variable lags. So that is going to be what brings consumption down, hopefully. What I'm worried about is this is a very different labor market. Post-pandemic, everyone's view of work has changed. There's the remote working, there's the wealth gap, there's age differences. The workforce is different. And I don't yet know, none of us will know what that will do for how unemployment reacts this time around.
Right. So it definitely seems like there's so many questions on the macro side and, what that can do to crypto assets. There's something you mentioned in your last newsletter was the lack of volatility in the crypto market. Despite all these questions, and this is kind of something I've been grappling with too, right? It's such an interesting phenomenon where historically such a volatile asset can just move so sharply in either direction. We've even seen it this week, right? You go from 29.7 down to 27.5, then you just immediately chop, right? It's just so you have this move over the course of an hour, then you chop. And then you chop 27.5, then you have another big move up, and then now we're chopping again. I want do you have a macro perspective or something of why this is happening? We have an idea a little bit on the option side, but it just seems very, very weird to us, especially considering there's pretty thin trading volumes on the spot side, and as we've seen, it has this ability to kind of trigger these sharp spot moves, but you don't. It's not like you move sharply in one direction and then you have these retracements and dead cat bounces or things like that.
I am so glad you brought that up. I wanted to ask you guys about the volatility issue because you do know so much more about this. And before I lead into that question, what is going on with volatility? Back at the beginning of the year, when volatility was at its rock bottom low, I'd never seen it that low before. I assumed, and I want you to tell me if I'm totally wrong here and why, I assumed it was because things were just so darn uncertain, the market was hurting so badly, and with a high volatility, unessential asset, you don't need Bitcoin in your portfolios, traders were just stepping away. And that was what, no activity, no volatility, rather than the other way around. You'd think activity would mean higher volatility because prices would swing more. But no, I think it was just that, traders are out, nothing's going on, therefore no volatility. But I've been seeing it head up, and then it's still really low, although there is more activity, judging from the spot figures, which is what I focus on. Tell me, please, I'm asking you, why is the volatility so low in Bitcoin?
Well, so, if you're looking at it from an implied volatility perspective and actually the cost of options and why those are actually so low, yes, they are low, but you could make an argument that actually they're not that cheap. And let me show you this. Here, let me just share a slide very quickly. So this is basically the chart that is examining, at the money implied vol versus realized vol. And when you look at the cost of options, right? So you can basically look at the red line as a proxy of that, the implied vol. And sure, it is still fairly low, but the reality is the implied vols are low because the realized vol is low, right? And because of this, the options are just, not that expensive. And it it's kind of like this sort of like inefficiency, potentially in the market where like you see these sharp, like 10% sell-offs where, spot goes from like 29.7 down to 27.5. And then you just have these insane, risk reward opportunities where you have the ability to purchase optionality for, some of like the cheapest levels since, the 2023 rally began. And I think that's exactly what we saw, right? You get these sell-offs, implied vol goes lower, and it's just kind of just like a screaming buy to play for a return to the 30K level from a directional perspective.
If you think about the options market as, dealer and vol traders, right? I mean, obviously they're implied minus realized junkies, right? So they would just look at this and say, oh, there's free money on the table. There's something like a 5 to 10 vol difference. I should definitely be selling vol. I think on the other side, you have, we have two macro experts sitting here. They have different views on, the rate cutting cycle, different views on, what's going to happen on the macro side. I mean, you have this level of uncertainty. Why would you not then go and buy a directional option? That's I guess the very simple thesis, right? Like if you're a smart vol trader, fine. You look at this, you're like, all right, this is high. This vol's high. But if you're just a guy who buys an option, puts it in his drawer, forgets about it, right? Like this is the best market for you, right? And it's the best market, I guess, for the marketplace in general because there's sellers and there's buyers, right? So I mean, I was checking some stuff out today. Just you can basically just very simple call spread trades. Like you can end up making 5 times your money for like in the next 2 months if spot rallies 15%, right? So you pay a fixed premium and you get 5 times your money if spot rallies 15%. Right? I was like, okay. I mean that seems we've had that move basically over the last week, right? Yeah. So it's I think it's a uniquely situated market where both sides can be happy in this trade.
If options are so cheap, why are people not buying them and pushing up the IV?
Well, I think we've reached our balance actually. Yeah, go on, Joe. I think you know about this more.
No, go on. So on. That's kind of
yeah. So like, I mean, like to me, it seems like it is very balanced, right? Like, so even if you buy an option, right? Like, many people are not doing it the way you think that they should do it. They are buying like call spreads or put spreads or like very not vol intensive trades, right? Just because they don't think it's gonna completely roof it, right? They think it's gonna rally like 15%, 20%, 25%. It's not gonna double, right? So that's one reason. The other reason is there is the balance between the dealers who are who look at this chart and say, look, I should be selling that, and then there's a bunch of people who want to buy that. So I think it's reached an equilibrium is basically what the market is trying to tell you.
What would knock it off that equilibrium?
Very much a range break. I think that that's the one answer to always what causes people to unwind this, because I mean, in a range break, right? If you think all dealers are generally position short vol, they're the ones who are like very quick to react and to unwind their position and put on unwind their position because they're generally leveraged. If you're like an investor, like a long only investor, you bought an option, put it in your drawer, you're not gonna handbrake turn on just because spot breaks, right? You might actually be quite happy with that spot break. So I think a range break makes sense for the market to kind of reprice higher on the vol side.
Yeah, it makes sense. Was been watching the options open interest for Bitcoin climb, and yet IV not really moving. I didn't understand why. So that makes sense. Thanks.
I mean, there's a couple of things on that. I say that there are this, you've got a lot of systematic vol selling strategies that's kind of constantly sort of weighing. Which again, as the guys say, if you're trying to play directional views, then actually vol's sort of pretty cheap to express those. The other thing I was going to say is if I think about how this year's sort of played out so far, when we came into January, this kind of peak rates, peak inflation narrative was really strong, and like narratives are super important for markets. And everyone kind of come in. Obviously, we had a really sort of big move in Bitcoin, particularly, and crypto broadly. And everyone was kind of grabbing them for the volatility and swallowing the upside because the market kind of didn't have it on. And there was a really nice kind of thematic, right? The Fed were going to pause. We had like the data for December was really weak, and then February come along, and all the data in February for January was really strong. And then it's like, oh, okay, maybe we're not getting the March pause. Maybe the Fed and we started pricing a higher terminal rate. And then that's kind of, again, sort of reversed a little bit in March, plus overlay that with all the sort of banking issues and what does it mean? I think there's a lack of conviction in the market in terms of the path ahead. I mean, we've obviously had that discussion, will the Fed cut, will they not cut? I think what really starts to see vol pick up, I mean, we've got this positive spot vol correlation at the moment, so it feels like the convexity is to the upside and where we'll see vol pick up. I think once there's a clearer path for the Fed, particularly, and a clearer narrative that can kind of give the green light to, okay, this is going to be a sustained move higher now. I think that'll be the thing that you'll start to see a lot of funds come in and play more aggressively for some of these sort of topside moves. And then you start to get the momentum and the range breaks and all that sort of thing. So I kind of think it's a reflection in part of a market that is kind of lacking a little bit of conviction, which is why I'm kind of quite bullish, because I still think we're under positioned generally in risk markets, because I think there's enough uncertainty at the moment to keeping people back from like, really lumping on a directional view.
Yeah, it's amazing that after a 75% gain so far this year, we're still underpositioned in Bitcoin. That's absolutely astonishing. I mean, I totally agree with you. But looking in the rearview mirror, that is very surprising. And especially when we know, I'm sure we all personally know, many traditional investors who missed Bitcoin in the last run-up and are not going to want to have to explain to their bosses or clients why they missed the second one.
Yeah, and that's why I think we see a lot of certainly when we get these sort of little sell-offs and vol comes lower, we see this this move to kind of own like sort of these wingy options, these kind of sort of cheap out the money options on the top side, where it's like, look, if this thing does rip, then I need to have some exposure to it and I need to own it. So you kind of, Joe, that's been a popular trade, right? To own the wings and put those trades on, right?
Yeah, it's been a very popular trade. I will say there has certainly been a lot less of that flow, because as we were rallying, kind of getting to the 26, 27 range, we saw a lot of very big wallets starting to buy upside, kind of like in the 32Ks to like the all the way up to the 36, 37Ks. But now that we've kind of sort of like settled into this range, well, now I own this upside that is, starting to bleed a little bit. That being said, it is fairly kind of out of the money. And what these wallets now are doing is they own those upside wings, but then they're selling, at the money straddles and selling vol against it. And that's kind of part of the reason as well, why implied vol is so low, because these guys need to collect some option premium to kind of, basically help, finance the theta bills that they're bleeding on that upside. And we always talk about on this podcast how like the crypto vol market, especially due to, less liquidity compared to, other markets, it's just a market of complete feedback loops, right? So you get people that will come in and sell at the money straddles kind of like 28, 29K. And then it basically just stuffs dealers with long vol, who in turn start bleeding it. And then basically as spot moves around, they're kind of gamma hedging these positions, basically muting both moves in both directions. So basically what that means is as the market is rallying, they're selling spot. And then as the market falls, they're buying spot. And given their delta hedging dynamic activity, it's basically helping mute that spot action. And that's part of the reason too, why, realized vol is so low, right? You have these moves up and then we're not doing anything. People lose conviction. They're just like, damn, I'm bleeding. They sell the vol, dealers hedge it, and then it just mutes move in both directions. And I think part of the reason too, why, it was like completely insane when we moved down to like 27.5K, how low the implied vols were. Like we were talking like, they're like literally like in the 40s, the lowest they've ever been. And I think a reason for that is, speaking to dealers that are active on Paradigm, a lot of dealers are actually long a lot of downside strikes down there. They basically are getting sold those strikes either via bilateral over-the-counter trades or trades that are happening on Paradigm where people are selling them puts. And then as the dealers get long puts, as the market moves lower, they're getting longer vol exposure. And they're getting longer vol exposure all while vol is not going up. So they're bleeding more, which kind of is another feedback loop as to why they need to continue selling. And then it works the other way too. Like as we rally, dealers are short the upside. They're short, the 32K strikes, 35K strikes. Well, as you get closer to those strikes, they get shorter vol, they get shorter gamma, they need to cover that. And then it's the feedback loop the other way. So that's kind of why you're seeing these weird spot vol dynamics as of now.
That is so
yeah. I mean, I think on your point, Noelle, about the institutions, being involved. One very clear sign that the institutional, because everyone tries to say institutional involvement in crypto is increasing, etc. But primarily Paradigm is an institutional, marketplace, right? And our market share has literally doubled from this time last year, right? So that's basically, so we've gone from 20% of crypto options to 40%, right? And that is basically telling you that now it's 40% of the market is institutional, right? So, that kind of tells you, it is happening. It is actually, that's a real data point that tells you the institutional participation is larger, but it can obviously be much larger, right? I mean, in TradFi, that number is a lot bigger.
And Sohan, to what extent is the low volatility today keeping some traders out? I mean, crypto is famous for its volatility. It's been one of the magnets for those that actually look for that kind of risk. To what extent is the situation today keeping traders out? Why are they waiting? Is that what you're seeing?
No, I don't think so. I think if you're a vol trader, you definitely have some positions in this market. If you've ever traded options, I would say that you are definitely, have some kind of position. You may not have a volatility position, as you might be long one option and then short another option, as Joe was saying. It's not as clear if you're a vol trader whether you just outright buy an option. You always maybe hedge with short dated option or sell a spread or something like that. But I definitely feel like the options market has if you ever traded vol, I think you are involved in some form or the other. The only people I think who are really missing from the market right now, because I don't think the no level of vol means there's not participation. I think there's a lot of participation. It's just that it's balancing, right? I mean, I'm fair to think who traded last year isn't trading now. And I definitely feel like it's only the people who, suffered very large drawdowns last year, in the multiple crises that we had, right? I mean, they've obviously, they've lost, I guess, capital, so they can't really get involved in this. I think the real upside is if we can convince more of the people who are buying long only spot to trade options, because I mean, honestly, this level of vol, they should be thinking about it. Options is always a scary word to people, but if you buy an option, you could only lose the premiums. Yeah, I mean, I feel some of these guys the
guys that have done the best on Paradigm. The guys that are doing the best on Paradigm were the guys that were just buying outright call options when, Bitcoin was 18K. And then, as we had this rally, they just continued to roll them. Sure, maybe sometimes they, those options expired out of the money, didn't make money. But reality is, on the ones they hit, they were 10 baggers or 15 baggers.
Yeah, absolutely. Yeah, it's
yes, and I don't think that the lack of vol is because it kind of, as Sohan said, there's you have these sort of crazy inefficiencies where if you're just a directional trader trying to get upside exposure, you have these insane opportunities. But also on the vol side, as we kind of showed on that chart, there's been this kind of fairly persistent, implied vol premium versus realized vol. And people love their back test. People love back testing implied vol versus realized vol and, playing with assumptions. Oh, if I delta hedge, at this frequency, With these parameters, like this is what I could have made, and people love backtesting that stuff. And I feel like a lot of like the pipeline that we're seeing kind of coming out of David and Sohan's team, maybe this is confirmation bias, it kind of feels like it's all guys like looking to harvest the vol risk premia via like overwriting strategies or like selling straddles. Like I'm pretty sure there was one literally put in the chat an hour ago where like somebody's like, oh, I want to sell 1 day options. And obviously potentially a dangerous game, but people run the back tests and people see these opportunities and want to get involved.
That is so interesting because, risk doesn't go away. It just moves, right? And people want risk. I mean, we have it's a misused word. People associate it with downside, whereas risk also does imply good upside. That's something that you would all very much understand, but, most investors still don't, and certainly observers and certainly regulators don't. One putting this back to the macro for a second, and then this will come back to Fed cuts, if you like, Dave. You'll like this one. Is volatility in the treasury market off the charts. In volatility in the safest asset in the market is totally off the charts because of market structural things. And the one scenario I can see the Fed cutting rates this year is if we start to see serious problems in the treasury market. That just cannot happen. And unfortunately, it is getting ever more likely through market structural issues, but also through the debt ceiling crisis and potential moves in the dollar, not to mention geopolitical issues that could send it spiraling. So this volatility in the treasury market, potentially influencing Fed actions, could feed through to the crypto market as well, because Bitcoin is the ultimate risk asset, which would feed through to crypto volatility. And it all melts together in a very messy, but very rather beautiful tapestry.
Yeah, I mean, and I think what's great, like, from all of our points of view, is now how as an asset class, like how integrated crypto is, and the feedback loops from TradFi into crypto, and then even from crypto into TradFi. It's funny. I think when I was sat in a bank, Bloomberg, which used to be pretty sort of anti-crypto, and would mention it. Now, you see in Bitcoin and the price of Bitcoin kind of being reported with kind of other major assets, be it treasuries, be it the dollar. It's kind of equities, treasuries, dollar, Bitcoin. What's moving, and it's kind of the correlations with traditional assets are now really important. So Bitcoin in itself is now kind of able to impact and have an influence on other asset markets, which I think is super interesting and shows like the maturity of this space as an asset class, I guess.
And the growing awareness. I mean, there are very few economists and macro investors that don't know what it is. Some of them have nonsensical views on the asset, but at least they know what it is, and it's something that, as you say, they see on their feeds every single day.
Yeah, interesting stuff. Well, no, because I guess as we kind of look to maybe wrap things up, what would be your kind of sort of main takeaways that you'd want to leave us with?
We hinted before at why Bitcoin's varied narratives are a key part of its outlook. We've discussed, I think, the risk asset narrative here. Bitcoin is one of the most sensitive. It is the liquid asset most sensitive to changes in liquidity. That's a very convoluted sentence, but I think you know what I mean, right? Of all of the risk assets that are out there in the market today, Bitcoin is one of the most sensitive to change in liquidity because it has no cash flows. Dave, you mentioned that, you'd be long tech because of long duration, but tech has a whole lot of risks that Bitcoin just simply doesn't. It's got earnings risk, it's got regulation risk, it's got the discount factor risk, which again, Bitcoin doesn't. So it's most sensitive on that. It's pure. It's a pure liquidity play, practically one of the only ones. It is also a store of value, and a pure store of value, because it is the only asset traded today in liquid markets that has a programmatic, transparent, verifiable hard cap. Even gold doesn't have that. If gold's price shoots up to $20,000, then different types of extraction technologies become viable. We'll be mining gold on asteroids, and suddenly we don't know what the supply is. In other words, there is no supply cap because the price will influence just how much that is. Real estate as well. We can build islands if we have enough money. So Bitcoin is the only asset whose supply is not affected by its price at all. That makes it a good store of value over time, obviously, but that makes a store of value. And we have the insurance asset. One of the reasons I'm particularly bullish on Bitcoin at the moment, even though I'm not so bullish on the liquidity outlook short term, is because of banking strain. While I don't think banking strain is going to lead to a flood of liquidity in the market through rates being cut or any other similar measures, I do believe Bitcoin, compared to the fiat banking system, represents an insurance asset. And it would be crazy for investors, retail, institutional, not to put just a tiny amount of their portfolios in something that does not depend on having access to your money via a centralized intermediary. So the diversity of narratives, and I'm sure there are many others that we haven't even touched on yet, the diversity of narratives lends Bitcoin resilience, which other assets, let's face it, do not have.
Yeah, that makes total sense. And those narratives, just combined with the lack of spot liquidity that we have, doesn't take a lot. Doesn't take a lot of belief or fervor in this thing to really move this market.